Hello, friends. In this session, we'll look into some of the factors which influence the profitability of banking operations. This is mainly in context of, this is mainly in context of international operations. So, international banking is actually a very complex uh, dimension where you are not only dealing with local authorities, but you are also dealing with international players where competition is going to bring in a big difference. So actually here funds are supposed to be coming in or they're going out across the border, which requires lots of documentation and technicalities. So hence you see this particular aspect is actually going to be very important. So we'll try to see some of the factors which actually affects the profitability of banks. Okay, let's start with some of the factors. Now you see these conditions are like macroeconomic conditions. So if you find that global phenomena is all going good everywhere, you see positivity, employment is booming, and you see per capita income is going up, consumption is there. You see there you'll see lots of positivity, and interest rate movements may go up also side by side, not only on deposits but also on loans. So this is actually going to have an impact. I'll give you one example. During demonetization, what happened is like banks got lots of funds. Like all high denomination values came back to the banking system. So deposits were there everywhere, but loans were not there. So you see, due to excessive deposit, what happened is like supply came in, but demand was not there. Hence, in order to promote demand, banks started giving cheaper loans. So this is actually a phenomena which depends on market forces of demand and supply, which actually determines the price. Next is like you see customer relationship. Now, if you are very customer friendly, you are very loyal, you are trustworthy, you are keeping a good track of your clients, you are doing a proper follow up, you are customizing their offerings. Now, when you have everything like this, what happens is like customers stick to the old banks or to the old relationships that they have. They don't want to switch it to the new partners. Why? Because you see, you know them very well. And switching means you're actually going to someone whom you don't have much understanding, with whom you may take some time to settle down. So, hence, you see, sometimes this also plays a key role. Let me give you some examples like people who do have their bank account with Punjab National Bank or OBC or some of your old public sector banks, and then they do have these accounts since very long, means 20-30 year old accounts. So you see, even though these banks are not offering you high rate of interest on their deposits, but still many customers will stick to their old banks is because of the element of relationship. Okay, so this also may induce your bank's profitability. Next is like you see cost management. So optimizing resources is very important. Now, when I say optimizing resources means a bank may have multiple branches in same location, may be very costly. So rationality needs to be there. So relocation of branches is must. Leveraging technology is must. Bringing in digital disruption is must. Because when you bring in, maybe initial cost may be higher, but what will happen is like overall on a longer tenure basis, you'll find your cost cutting happening, and it will enhance your profits. So all these factors are actually influencing your profitability. Next is like you see, let's see what type of revenue sources are you in international banking. You have cross border lending, so you have to lend, or if you are into borrowing mode, you have to borrow at international rates. Like when I'm quoting international rate means LIBOR, London Interbank Offered Rate. So your reference rate will be an international phenomena. So local rates will be different, international rates will be different. So you need to see how you gain out of it. So if you do have an opportunity, arbitrage opportunity, and cash it and get into profits. Borrow it from international market very low, lend the same money in your local market at a bit higher rate. So you see this actually gives you scope and sustainability. Next is trade finance. So if you go into trade finance, where you have letter of credit, you have bank guarantee, you have documentary collections, UBP collections. So there you see you can make good amount of profits with proper margins in it. Foreign exchange services, again, if you are into currency exchange, buy rate, sell rate may be having a gap, so which is actually making banks margin. So if you are into it, you make profit. If you are into hedging contracts, so again you'll get premium for your contracts, and this is how you actually cater your customers in terms of risk management solutions, and you help them out with some customized product offerings. as per their need and situation. Next is investment banking, where raising capital, you're actually helping your client for merger and acquisition. You're helping your client with some sort of advisory services. So you charge your fee. So fee is non-interest income. So maybe interest or maybe non-interest revenue sources will add up to your profitability. Now, next is your cost structure and efficiency measures. Now, you see staffing cost and compensation that you pay to your staff is actually going to influence your profits like anything. Let's take two examples. One is a public sector bank where salary is fixed, increments are fixed, compensation benefits are given very clearly in black and white. In second institution, it is all based on your performance. You see, what happens is, like in first type of public sector institutions, you're getting overburdened with the financial costs. So even though there is no performance, you have to pay for it. But in private sector, where you don't have anything and you are going into a contract mode, there, if your staff is not performing, you don't pay it to them. So it is only paid when you have some sort of earning. You do have some sort of benefits. So cost benefit analysis is very important. So if you have it, institutions will flourish like anything. Hence, SBI is on a negative side, but whereas on the other side, HDFC, ICICI, Kotak Mahindra Bank, they actually are winning this particular point over SBI. Why? Because they have something which is negotiation based. So bargain is all possible and things may change according to your situation. If you earn profit, then you share it. If you don't earn profit and you go into losses, need not to share. Next is technological investment. So it is must for every organization nowadays to survive, because disruptive innovation is, like you see, bringing in new challenges for banking system. Now, banks who are able to bring in new technology, they are good enough to have their own R&D. They are incorporating new product features into their existing products, will be able to survive, even though their initial cost is there. But you see, longer operational cost will be lesser as compared to conventional players. Now you see, you can even cater people at large beyond your branches 24 into 7. So what gives you an opportunity here is to make more money from this. Like you see, you have increased your customer base, hence you make more money. Next is regulatory compliances, means many a times regulators may bring in certain policies where you don't have much of choice, and you have to engage in the same, like environmental, social and governance practices, which is actually the talk of the town now. Every institution is going into green banking. So all institutions who are indulging themselves into green banking practices, they are supposed to be given loan at a concessional rate. So when you're giving concession, means you have to recover it from somewhere. Similarly, on geographical footprints also, so you have your branches, you have to optimize your network, reduce your cost, increase your digital presence, and you can have more revenue flows. Now you see, same is the case. Uh, like you see, regulatory and compliance landscape and compliance considerations. So anti-money laundering practices, if you have and you are able to detect them easily, will be good. But if you have to spend a lot bringing in technology to have proper detection and then preventing all these things, means again it is going to have an influence directly or indirectly on your profits. You imagine you're making profit in such competitive environment with lots of effort, and you're getting penalized for your wrong practices. Let's say you're not able to diagnose anti-money laundering, which is happening in some of your branches, and whatever profit you have earned with your hard work is all gone with this. So it may have a direct or indirect impact. Next is capital requirements. Now here we can put in capital adequacy ratios, which are required. So you need to have minimum capital. But imagine a situation where you don't have the minimum capital requirement. What will happen? RBI may put in a check on your deposits and your loans, may put you into moratorium. So in moratorium, you see, your reputational risk is there. Not only your reputational risk, but also you see, you will not be able to bring in more business, new business, may lose certain opportunities. So capital requirement, sometimes when you borrow it from market and you see interest rate may be on a higher side, may affect your profits. Data privacy and security. So if you have a security lapse in your bank and maybe some of your clients go into court for compensation, and you see, you are not able to keep their privacy in place and intact, so there may be some compensation that you have to pay from your pockets. So this is again going to affect negatively. Your profitability may go down. Now, a major dimension where it is going to be having an influence is like competitive dynamics and market share. How much market share are you holding? So it is like in Indian banking system, you see you have public sector banks, you have old generation private sector banks, new generation private sector banks, foreign banks, cooperative banks, regional rural banks. Then you have peer-to-peer lending model. Then you have NBFCs. Then you have new payment banks. So many service providers. So you see your market is really competitive and very very dynamic. So a slight change in your interest rate will have a severe impact on your margins as well as on your competitors. Now you see here, if you have intense rivalry, and so survival of the fittest is your key. So there maybe sometimes you have to bear a loss, and maybe if you bring in some disruptive fintech technologies or new players are entering into market, so maybe old players, it's time for leaving the market or to adapt to the given change. Adaptation means bringing in a change in your ecosystem, training your manpower into new technologies and getting the benefit out of it. So after cost you have some benefits too. Then is like developing your niche area and then catering those niche sectors very well, and getting profits from those areas. Like I'll give you one example here: South Indian Bank, Federal Bank, Karur Vysya Bank. They're like you see South-based banks. So I'm just taking the example of South Indian Bank right now. What they do is like it is a Kerala-based Catholic institution. So most of your their management people they are from Catholic origin. So what they do is like when they try to open a new branch anywhere in India, North India, they try to pick some of the areas where you have that community available to you. So when you go there, you do have a Catholic church, you do have some Catholic institutions, schools, educational institutions. Simply attach to them, get their accounts, and cater them. Now you see, you have a very niche area. You have a very selective clientele base. So cater to them, and then you can cater to rest. So you have actually achieved your primary objective, and now you're going into your secondary objective. Next is like emerging trends and technology innovation is what is going to influence your profits. Mobile banking, blockchain technology, artificial intelligence, and cyber security issues. So they all are actually requiring you to invest heavily in the infrastructure part. And then you see, once you have it in your pocket, then you can use them for bringing in heavy profits. And you see, leveraging technology is must in current scenario where you have to compete with the unknowns. Unknown means not only the local players but also the international players. So if you have technology on your backing, so you see you will be able to survive. You are able to do data analytics. You are able to bring in machine learning and various other things that actually helps you in survival of the fittest game. Now you see, strategy for enhancing profitability. Some of the points which have been mentioned is like diversification. Don't go into any selective area. So you see, every area should have a tolerance limit. So beyond which banks should not take any exposure. So if you feel that you have already over exposed to a particular sector, stop lending to that given area. So diversification is key. Second is operational efficiency. Increase the operational efficiency of staff member by giving them targets, by putting them into particular evaluation criterias on regular basis so that everyone is able to deliver their best. Now, you see, most of the time, staff may not be able to realize their potential, but when you give them the targets and you give them the timelines, many a times you see they overachieve those targets. So you see what you are bringing in is like you are bringing in competitiveness and you are improving the operational efficiency of your staff member and your branches. Next is geographical expansion. Go into certain areas where you don't have any coverage. Go into like you see, go into taps, collaborations with other institutions like banks. State Bank of India having a collaboration with LIC or Post Office of India to offer banking services there in rural areas. You see, this is a win-win scenario for both the parties. Then next is like you need to have client-centric approach. You see, in order to have long-term relations, you have to cater them well. You have to look into their problem, and this is how you are going to be a profitable institution, even if market is very tough. Even if many people are leaving your market because of very tight margins that you have. Hope you understand this concept. Good day. Take care. Thank you.